Fair
Again?
enough. Thank
All right.
you.
So, good afternoon, everyone, and welcome. I'm Casey Snyder, and glad to be joined today by Erica Sullivan as well as Tom Sidorik. And on behalf of everyone at Clove Hitch Advisors, we want to thank you for taking the time to join us. And as we reflect on the first 6 months of 2026, we think it's safe to say we are living through an extraordinary market environment. Headline risk that never ceases to amaze. Inflation and gas prices are high again, AI and the pace of change, and oh, yeah, we have some midterm elections around the corner. So there's no shortage of subjects to discuss. And our purpose today is the same as it's always been, and that is to help cut through that noise and provide perspective that's grounded, that's durable, and useful as we plan for the future. And our conversation this afternoon will follow a familiar structure. We'll start by looking back at what's unfolded over the past 6 to 12 months. From there, we'll attempt to provide some historical context about today's unique environment. And finally, we'll share the key themes that we're focused on as we plan ahead, both from an investment and planning perspective. And a quick note on format, we welcome questions using the chat feature. We will do our best to address them, if not during our conversation here at the end, depending on our flow. And for confidentiality, please use first names only when submitting questions. And assuming compliance approval, a recording of today's conversation, along with a full slide deck, will be shared with all attendees and those who couldn't join live, so you can revisit or pass it along. And as always, if there's a friend or family member who you think may benefit from this perspective, feel free to share the replay or future invitations. So, with that, we begin by looking back and feel it's only appropriate at this point to start with some doomsday because we are living through extraordinary times and the barrage of doom and gloom in the headlines continues. Except when you look back, you realize doomsday warnings are expressed almost every year and from some of the most revered and successful investors of our time. So here we have Ray Dalio and Jeremy Grantham, both legendary investors, and their perennial tech bubble calls. Now, let's be clear, eventually they will or may be correct. But had you adhered to the May 2nd, 2016 Wall Street Journal article, I see a laser pointer here, about the tech bubble bursting, or the article here from 2014, you would have missed out on a tremendous market. Now, something to note, markets have a long history of climbing walls of worry. That's why we've titled this slide, The Wall of Worry Continues. And what this means is that it's only when the worries tend to morph into the this time is different phase or euphoria takes hold. That's usually when markets tend to roll over. Otherwise, markets have this long history of climbing these walls of worries as we've seen. And what's so unique about our current situation is how we have some of the most successful investors of our time at complete disagreement about what's to come. So we open our conversation today with a subtle reminder to tune out the headlines because your financial self, and for some of you, maybe your nervous system, will thank you in the long term. Tom, anything you'd like to add?
Well, I think you captured it all, Casey, but I think it's important to remind our viewers and listeners that bad news sells. Good news doesn't sell. Bad news sells. And there's a reason there are a lot of multi-billionaires in the media world because that's how they made it, by selling bad news. It doesn't mean it's all going to play out. And the reason you invest your time in doing these conference calls that we started many, many years ago is because we believe in what Cy Sims used to say. He was a retailer, and his tagline was, "An educated consumer is our best customer." We like our clients educated, we like them informed, and whether it be bad news or good news, it's going to be in their hands so they can deal with it. Thank you.
Well, and we'll start with a little good news then, as we continue to look back. And we'll flip over. This is a real quick reminder for context when we look at 2025 that diversification paid off in a big way. There was a significant reversal in leadership. So, again, 2025 results, this was gold taking the lead with overseas equity markets outpacing US markets by the widest margin we've seen since the 1990s. And this rotation of leadership continues through mid-year 2026. So again, just a really quick reminder. Uh, let's see here. I just had a quick question. Someone's getting a little bit of feedback. I just want to make sure. Erica and Tom, are you getting any feedback from the microphone here?
No, it sounds clear here, Case.
Okay.
Mm.
All right. So now that we look at 2026, the leadership continues to rotate. This year, emerging market stocks have continued in the lead, with now small caps and mid caps taking up sort of the second and third place, while US large companies and more developed international equities, again, this is through the first half of the year, being sort of mid range. And then you can see that cash, tips, bonds, gold flipped negative, and Bitcoin continues its retreat into negative territory. And this is just that quick reminder too. Early in the year, after gold delivered such a strong year last year, we received a number of calls and questions. Hey, should I own some gold or should I increase one's gold exposure? And actually, we were looking at it quite the opposite. So for many of you, or for those of you that do own gold, we were evaluating whether or not to trim because of the strong performance over the prior years. And so the story continues, diversification continues to prevail. And if we look back, continuing to look back, this is also a quick reminder. We had this slide in our 2025 outlook as we discussed small companies being relatively cheap because of how they have this long history of lagging larger companies during times of early innovation. And what we expressed during our call was that if history rhymes in any way, that these small companies may be poised for strong performance as the AI cycle picks up and AI works its way into various sectors. And in many respects, this is right on cue. As we just showed you, small and mid-sized companies here in the US have been leading the way so far this year. Now, small companies may not be appropriate for everyone because of their higher risk profile and because they're lower yield. So it doesn't generate the dividends or the income that many investors may benefit from. But for some of our younger savers and for those with a higher risk profile, this has been an area within the market that we've added to over the past few years. Also looking back, the Mag 7, the Magnificent Seven as they are referred to, they've been a theme of conversation because of their unique concentration within the S&P 500 and their extraordinary performance, except we've seen a pretty significant shift over the past 6 to 18 months. So, Erica, why don't you mind sharing, or would you please share a bit on what's happened here with the Magnificent Seven that everyone fell in love with?
Yeah. So as of the end of June, the Magnificent Seven were actually collectively negative on the year, down around 2%, while the S&P was up over 10%. Now, a year ago, it would have been really hard for investors to envision the larger US market being positive, while this particular group of stocks that had dominated the previous 2 years would be in negative territory, but here we are. And the reason for this is not because there was any level of deterioration within these companies necessarily. It was actually just a very normal and healthy expectations and valuation reset after several years of extraordinary outperformance. So there's been this rotation out of the more expensive areas of the market, i.e. tech, into cheaper segments that haven't appreciated the same way these names have. So again, it's a classic example of, I'd say, the cyclicality of markets and really the broadening of returns as a whole.
Nice segue there, Erica, because the broadening of returns is our next theme. And this image reflects the extent of which we're seeing this. And again, continuing with this rotation of leadership, this graphic here, we know it's a little bit busy, but it shows the share of individual stocks outperforming hits multi-decade high. So over here on the far right, at the end of the first quarter of 2026, over 62% of S&P 500 companies outperformed the broader index. This is the highest figure in more than 2 decades, in a sharp reversal from the narrow Mag 7, Erica, that you were just commenting on. And the last time we witnessed this sort of broadening was during actually the tech bubble or the tech bubble collapse. So the reason why this is relevant is if you think about the tech bubble in the late 90s, tech became a disproportionate share of the index as a whole. And when the tech market started to collapse, it brought with it all of your broader indexes. But had you been diversified and had you had broad exposure across multiple sectors, what you can see here is many of those sectors or many of those smaller companies were actually achieving highs even as the market as a whole was falling because of those more heavily weighted tech companies. We're seeing a redo of this, except this time without technology collapsing. And this tends to be a relatively healthy sign. And why this matters is these sorts of environments tend to favor active management and sector diversification. And again, only reinforces the need and importance for diversification, which has been something that we've been positioning for over the last couple years. Also, from our prior slide decks, this is one of my favorite charts, which provides the important reminder that today's leaders are rarely tomorrow's. And it shows how change is constant and how I'm going to use Erica's line here. It's difficult to see the picture when you're in the frame. Thank you, Erica. And what we can see here is leadership by decade. So you can see 1980, 1990, 2000, etc., and the top 10 companies at the time. And anytime you see a company with a light gray shaded box, it means that the company itself underperformed the broader index over the coming decade. And anytime you see a dark gray box, it means that a company outperformed the broader benchmark in the coming decade. And the takeaway here is you can see there's a whole lot more light gray boxes than there are dark gray boxes. So this graphic reflects how companies tend to deliver outsized returns in achieving that top 10 status. Think about the Magnificent Seven and their achievement in getting there, but how they often lag broader markets once they achieve that status. And it's not because they're bad companies. It's often quite the opposite. They're great companies, but their price can't continue to appreciate at the pace that it did during its robust growth spurt. And this is also a reminder that leadership by way of country also has a history of rotation. So during Japan's dynamic run in the 1980s, its market cap as a whole, once upon a time, was over 40%. Today, its market cap is closer to 5%. And if we think about the US in the 1980s, its market cap as a whole was around 30%. Today, we're north of 60%. So rotation is constant. And Tom, I think you had something you'd like to add to this.
Well, I just remember the 1970s and my dad's excitement about how Japan was just burying the United States. And relatively speaking, they were. You just talked about their overweight and their concentration. What's fascinating is people never really understood the importance of foreign diversification. We did. We've used it for over 40 years now, or I have, and you have as well, Casey. And the thing that's also contributing to this is, of course, the drop in the US dollar, which provides a tailwind for foreign equities. So you're getting kind of a twofer when you own foreign stocks right now.
Yeah, and I think my takeaway from this as well, Tom, is that, we look at this lineup here coming into 2026, and in all likelihood, there will only be two or three names on that list, maybe 5 to 10 years from now. So change is constant. I think you may have referenced this, Tom, or you may later on, but we never invest in the rearview mirror. So, all right, as we conclude our segment in terms of looking back over the last 6 months or so, moving away from equity markets, Erica, would you please provide a quick update on the bond market as a whole, because it has delivered a little bit differently this year compared to last?
Sure. So the good news on this front is that rates today continue to live in what we would consider a relatively normal range. So call it, 3.5 to 6%, give or take. So that's good. From a total return perspective, however, the big difference between this year and last year is that last year we saw really strong mid-single digit returns in the fixed income space. And this year, so far, fixed income as a whole is flat. And that's really in large part due to the return of inflation, both from the situation in Iran as well as continued AI investment and other geopolitical factors. So While it has been a bit of a drag on portfolios, relatively speaking, it's less of a concern from our standpoint because of those higher income streams. And we've also made some strategic shifts within the fixed income segment of client portfolios to make sure we're addressing these inflation concerns should they persist. I should also just note as a reminder that interest rates and bond values move inversely to one another. So as rates rise, bond values fall, and vice versa.
Yeah, and if anybody's checking day to day, they will have seen that within their portfolio over the last few days. As the war overseas continues, we've seen interest rates escalate over the last few trading sessions. And with that, you see those values come down. But to Erica, to your point, it also means a higher income stream now to come. So it's kind of a catch-22. All right, that brings us to the end of our looking back. We are going to shift gears and look to provide what we believe is important context as we attempt to address why markets have continued to appreciate, the resilient multi-generational consumer, the return of inflation we were just discussing, and historically rich valuations. So we begin, I think, with the question that we receive most frequently right now, which is when someone comes in and we're having the conversation about markets, they say, why haven't markets fallen apart yet? Why haven't they cratered? How does this continue? And one of the big reasons for this has been earnings. And so when we think about total returns are a combination of three things. We have earnings, multiple expansion, and dividends. And over the past few years, at least in the US, multiple expansion was doing most of the work. And this is when investors are willing to pay a higher price for the same level of earnings, which is what leads to increasingly expensive markets. And eventually, you either need earnings to pick up in support of that price, or you find yourself in a bubble. And what we've seen over the past 2 to 3 quarters, and even so far this quarter, are really strong corporate earnings, and not just domestically, but overseas as well. So consensus estimates right now are calling for double-digit gains across most major markets in 2026, with emerging markets being the standout. And a lot of this is attributed to AI-driven chip demand, but this is quite the figure. Now, there's a catch, though, when it comes to earnings, because it's all about expectations. And if markets are anticipating great earnings and only good earnings are reported, then that can be enough to alter the trajectory of sectors or markets as a whole. We've also seen that over the last few days where earnings were very strong, but they may have fallen a little shy of what estimates were. It can also, though, work in the opposite direction, where if markets are expecting good earnings and excellent earnings are delivered, that's what can continue to support these appreciating levels. But the bottom line here is earnings have been doing the heavy lifting, and that tends to be a very positive sign. And a big reason for these lofty earnings expectations and strong results, if not the primary reason, has been AI. And it still appears that we're in the early innings of the AI story, although its usage is spreading and maybe in ways that would surprise a few folks. So, Erica, will you please provide some context about AI and its adoption rate as usage expands?
Yeah. So looking at this chart, if you look at the left side of the page, you can see the total adoption rate of AI amongst these various sectors just about a year ago. So as of, I think, June 2025 was only around 9%, pretty low. Fast forward 1 year, over on the right-hand side to June 2026, and total adoption has more than doubled to now around 20% in 1 year. Now, what's even more interesting is if you compare the sectors in the bottom half of these graphics, so admin support, wholesale trade, and on down, you can see that their adoption rates have almost tripled in some cases, which is interesting as we start to see AI usage pick up in some of these non-tech related sectors at a more rapid pace than even some of the more tech-centric sectors themselves. We've talked a little bit about this on past webinars in the sense of these second and third beneficiary companies starting to benefit from AI usage in ways that we haven't really seen play out quite yet. So that'll be interesting. Now, while adoption and usage as a whole has increased, there was a recent McKinsey study that reported nearly 90% of companies that are using AI still are not recognizing any significant value as a result of the integration yet, which, as Casey said, says we're probably still in the very early innings of this. And really, I think the key phrase here is yet, because we know in theory, as AI capabilities continue to improve, adoption rates will continue to rise, and that should translate into notable productivity gains and earnings over time. That said, again, we have a long way to go, and progress rarely moves in a straight line, as we know. So, like past productivity revolutions, we'll expect some winners, some losers, and definitely some bumpiness along the way.
I think, Erica, we quoted, I want to say it was the CEO or CIO of Vanguard, whether it be earlier in this year, maybe, where their comment was the more optimistic you are on AI, maybe the less AI you want to own, and you want to own some of these other beneficiaries or these other sectors as this cycle continues to play out. And we're seeing that within this chart right here.
Yeah, I think there's a great analogy when the telephone came out. Alexander Graham Bell created this magnificent tool. It wasn't buying the telephone stocks that made money. It was all the companies that benefited from the telephone that made money.
Yeah. Well, and Erica, to say that it's going to be bumpy, this next image gives us a sense of kind of the scale and size of what is really going on. And we respect how many of you may have AI fatigue, given its sudden fame and it being a popular subject of interest. But we do want to try to convey the financial significance here. And so what we see here is Capital Group estimates that AI-related investment could exceed China's decade-long industrial build-out. So China's build-out acted as sort of a stimulus package for the world, while also delivering deflation in ways that helped keep global inflation in check. Right? Asian markets and economies, as well as Western companies, benefited significantly during this stretch, and it equaled around $20 trillion in investment. So for context, President Biden's Inflation Reduction Act, that was quickly deemed inflationary, was estimated to be around $1 trillion. So we are talking about significant money here. And Capital Group estimates that from 2022 to 2032, the AI investment in total may amount to nearly $30 trillion. Now, that's almost the size of the US economy as a whole. It's massive, and it's not just tech or chips and server farms. And to Erica, to your point, winners and losers and it being bumpy, AI is following a path similar to prior technological transformation. So there tends to be this, we overestimate the near-term impact, but then often underestimate the long-term investment in change. And the reason for this is everyone can see the potential of AI to change the world. Therefore, it attracts tons of money. And therefore, by default, there ends up being this overinvestment. And following overinvestment, there is often this sort of destructive competition. And we're starting to even see some seeds of that from time to time when something new is announced. And then sometimes there are waves of bankruptcies, and then sometimes there's also some painful consolidation and some temporary collapse, so to speak. And this process has been true with transformative technologies dating back to the railway booms of the 19th century, all the way through the internet boom of the 1990s. And ultimately, these technologies or inventions did change the world, but not without some wild economic disruption along the way. And I think Jamie Dimon even recently stated, hey, yes, there are going to be winners and losers, but it is way too early to predict who they may be. All we know for sure is that the future is going to look different than how it stands today. Now, aside from AI being a driving force within markets, there's another subject that we don't think garnishes enough attention, and that being the G-shaped economy, or sometimes we're referred to as the generational economy. And it's something that we've seen within our practice over time, but especially within the past few years. And the great transition of wealth from baby boomers to Gen X or millennials, it's been written about for the last 10 to 20 years, but it's often discussed as if it was going to be this sort of big bang moment. Mom and dad suddenly die together, and Susie and Jimmy receive their modest inheritance, except In reality, it's not a sudden event. And with markets and housing having appreciated the way that they have over the past 5 to 6 years, it's created situations where aging parents are realizing that it's unlikely they'll draw down their nest egg and are gifting to the next generation. So, Erica, we're having these conversations weekly, if not sometimes daily. Why don't you share a little bit more about this and how we're working across generations?
Sure, yeah. So, yeah, this is a conversation we're having more and more with clients, and it's significant both from a market and a human perspective. Market because it's literally continuing to fuel consumption, and human because it's helping the next generation in meaningful and sometimes necessary ways, given the rising and sometimes prohibitive costs that they're facing. So, yeah, we're having a lot of these discussions around the warm gift as opposed to, the cold gift. And we're not talking about frivolous spending or funding trips to the Maldives. We're talking about clients helping their kids and grandkids with down payments, renovations, childcare costs, educational costs. And in some cases, we're even seeing clients who, in part due to market factors, were able to retire earlier than expected and are now helping with the gift of their time, which I can personally say, as a benefactor of the latter, is a huge deal. So thanks, Mom. But we are spending quite a bit of time in this space helping clients strategize gifts because there is a lot of planning that goes into these decisions from a tax, investment, and estate perspective. And interestingly, as Casey mentioned, we found in many cases it's morphing into a multi-generational planning conversation as more and more clients find themselves with balances they're unlikely to spend down within their lifetime. So we're working alongside their CPAs and estate attorneys to help facilitate thoughtful and responsible transfers of wealth to the next generation over time.
Yeah, Eric, I think about maybe 10 or 12 years ago, we were having conversations about how or at least I was speculating that the multi-generational household may return as aging parents and adult children come together in some way by way of necessity. That hasn't fully materialized, but to what you just outlined and what we're seeing on a weekly basis, the multi-generational balance sheet has because they're looking at it as one, and we're looking at it as one when they would like to. And by way of you just said, there are a lot of efficiencies that can be created and a lot of tax savings had, and it's having a pretty significant impact on the economy as well.
Yeah, in light of some of the more recent tax law changes last 6 years, there's a real opportunity for multi-generational tax planning, not just wealth planning, not just cash flow, but tax planning because of the two Secure Acts that passed.
Yeah.
Yeah.
And that G-shaped economy, as you mentioned, Erica, right off the bat, is one of the reasons um, that the affordability crisis, let's say, has been able to continue for as long as it has, because it's created a more resilient consumer in maybe an unintended way. But inflation comes up in almost every meeting we have because of how life has become increasingly expensive. If we look over here, and we look at inflation dating back to what 2021, we experienced a pretty significant spike during the pandemic, and then it came close to maybe normalizing to some extent, and now we're seeing a pickup again as a result of the war in Iran, AI investment, and look, I mean the economy is relatively strong, so there is still strong economic growth. So much so that markets now expect, you can see over here on the right, that they now expect a rate hike from where we are today up to around 4%, compared to where markets were 6 months ago, when they were expecting more of a rate drop. And regardless of where rates trend in the near term, we do believe that the disinflationary machine that ran from 1990 through around 2020 is breaking down, and the long run equilibrium that people have enjoyed, this sort of 1.5 to 3.5% inflation, appears to be moving more towards the 3 to 4 or 3.5 to 4%, with the potential risk for episodes above 5%. And there are, again, a lot of questions about where inflation goes from here. Does it trend higher because of AI and over-indebted governments and central banks looking to inflate their way out of debt? Or do interest rates eventually trend lower because of demand destruction? That being like inflation is too high for too long, the G-shaped economy kind of runs its course and consumers have to pull back. Or maybe there's an uptick in job loss related to the AI movement. We don't know. But we do believe that we have moved out of the low inflation, low interest rate era. And this is something that we've been planning for within fixed income portfolios. And it's also why we've continued to harp on the importance of dividend paying equities because of how they tend to be more resilient and they have a better history of keeping pace with inflation over time. Tom, something to add here?
Well, we talk about a lot as a team, and I think the clients have heard it periodically, but we talk about biases, and we try and check our biases at the door when we come into work because biases don't do us any good. Recency bias prevented people from buying 14% government bonds 30 years ago. And more recently, we've had low interest rates, low inflation. And if they base their future on that paradigm and it didn't unfold that way, they're having some surprises. So we work very hard to overcome the biases that we know that are present in the economy.
Yeah. And maybe this is speaking of biases within the economy or recency bias. Markets have remained expensive for a while. We're talking about great earnings. We're talking about the G-shaped economy. We're talking about AI. Just to make sure that people don't think that we've gone Pollyanna on you because of these factors, Erica, please sober us up with a reminder of how expensive this U.S. market remains.
Lest you think we forgot to include our favorite chart. We wouldn't do that to you. No, you can pretty quickly see not much has changed on this front. So as a reminder, the black line here, Casey, if you wouldn't mind highlighting, this is the trend line, and this blue mountain chart represents the price of US equities. So you can see today we continue to sit way above the long-term trend line, 207% to be exact, as of the end of May, which, to put that in perspective, is a 4 standard deviation event. That's not supposed to happen. There's no history to compare this to. Now, to be fair, this chart is capturing the whole S&P, but as we discussed earlier, there are really 10 companies that are the main offenders, while other areas of the S&P are a little cheaper. But no less, what goes up must come down, and at some point, returns will moderate back to trend. We just don't know when or how. So as before, this does remain one of our greater concerns, and it's the reason we continue to address risk creep in every client's portfolio to make sure we're remaining disciplined within our allocations and aren't overexposed to the expensive areas of the S&P when returns eventually do moderate. So again, this is less about prediction and more about setting expectations for the future and planning responsibly.
Well said, Erica. And Tom, were you going to add anything to this?
No, I didn't bring the chart out. You mean this one? I didn't. No, I didn't bring it up.
Yeah, exactly.
Okay. Recency bias.
All right, well, then that brings us to the end of our important context section as we move into key themes for the future. Continuing with a bit of good news here and bringing back capital market assumptions. These are published by way of Vanguard. It is their outlook on the next 10 years in terms of what investors may expect from various categories of the market. And in many respects, some of these categories have improved over the last 6 months because of what we're talking about as it pertains to earnings and the resilient consumer. Looking up here, you can see US equities as a whole. You probably don't remember this, but this is a bit higher than what was published here 6 to 12 months ago. US growth, which is a category that has been incredibly expensive, it has fallen some over the course of the last 6 months, therefore has a bit of a better outlook. On the negative side of things, emerging markets had a strong outlook about a year and a half ago, but because of some of those robust results leading the pack last year as well as this year, we've seen some of the forward or the forecast for this moderate some. So in general, the forecast has improved a little bit. On the right-hand side of the page, when we look at fixed income and common bond market or common areas of the bond market, pretty consistent across the board. You're looking at 4 to 7% yields. To Erica's point earlier, incomes remain attractive as inflation ticks higher, so do interest rates, and then forward incomes still look pretty appealing. So in general, the outlook has improved some. That's not to say it'll be a linear path. Let me be clear. Now, we've talked about how we're living through an extraordinary market environment, and I think, Erica, you may have just referenced this, but the concentration, the level of concentration in many equity benchmarks has increased significantly over the past few years. And what we can see here, again, the 10 largest companies in the S&P 500 represent nearly 40% of the index. That's been true for the last 2.5 years or so. And it's a level that we haven't seen since the mid 60s. And what's unique now is that we're also seeing this overseas to some extent. Look at emerging markets over the course of the last 2 years as AI and chip has really appreciated in value. We're seeing significant concentrations. And this serves as a reminder to diversify not only across regions, but beyond the largest names. It's no longer enough to simply own international benchmarks or indices. You need to ensure sector diversification moving forward because of these concentrations, and this is where stock selection can be beneficial. And when we unpack these concentrations, you can really start to see the differences between markets. So over here on the left, you can see the US. This is emerging markets right here. These are heavily concentrated in tech. We can see that blue is meant to represent communication services, green, consumer discretionary. But for anyone who can see these names, we know that these are largely tech companies. We have what do we have here? A healthcare company cracking the top 10 here in the US. If you look in emerging markets, the story is the same, with one financial company breaking into the top 10. There are some emerging market indices where 3 names make up nearly 50% of the index, so concentrations there are extreme. And it's only when you move out into the Eurozone and Japan where you start to see some additional colors representing different sectors. So financials, we see some industrials, even a utility company cracking into the top 10 in the Eurozone, and then that same story in Japan where you can see more diversification. So for additional context here, in 1980, fossil fuels represented 29% of the S&P 500. Today, fossil fuels are around 3%. And at the peak, again, of Japan's late 1980s equity boom, Japan was 44% of global market cap. It's around 5% today. And it's because of how markets evolve that we evaluate sector exposure on a regular basis as part of our review process, and whether it be in search of opportunities or to mitigate risk creep by trimming the winners along the way, because the only thing we know for sure is that the index composition of today is going to look different in the future. And if we move away from equities and look at the bond market, again, looking into the future, we're seeing some of the best starting yields that we've seen in the past 15 years. So what we can see here within the graphic, this is yield to worst in subsequent 5-year annualized returns. It's color-coded by decade. You can see the returns over here on the left. And what we can see here is the 1980s, as interest rates began to fall, delivered some really strong results when it came to 5-year returns. A little less so in the 90s, as interest rates again continued to fall. We work our way into the green 2000s, still a very respectable return. And then it was the 2010s, this low interest rate, low inflation era, which brought returns way down. And if we look at the 2020s, it's been pretty anemic. Well, not anymore. We can see here with starting interest rates being where we are, these are some of the best starting yields we've seen in a while. And with higher starting yields, it means that there's less interest rate sensitivity than there was in 2022 because your starting point's 5%, not 0. And in theory, this provides diversification from equities in a scenario where economic growth slows considerably, because there's room for the Fed to cut rates now compared to where we were only a couple years ago. However, there are new risks within fixed income as the world takes on historic sums of debt in public and private markets. And with geopolitical tensions and deglobalization, even treasuries may not provide the same safe haven that they have over the past 40 to 60 years. And if inflation continues to trend higher, it may dampen some of these real returns in the near term. So for now, higher income streams remain attractive, as does the forecasted return, but it's critical that bond allocations remain diversified. Tom, something to add here?
Well, I just back at the last slide, we look at capital market assumptions. One of the other high points besides what stock markets look like is the bonds for the first time in many years look like they're going to generate real meaningful returns. And they are acting as a hedge against volatility in equities. Today may be a good example. 30-year bond up over 5%, so the stock market sold off. That may continue if rates stay high, but bonds are finally paying us something, and that's a welcome set of circumstances.
It's nice to be compensated for being conservative. That was a
Yeah,
really unpleasant stretch in the 2010 to 2020 range.
amen.
All right, now we're going to move away from stock and bond markets because there's a third market we'd like to touch on briefly, that being private markets and IPOs. And we tried to squeeze this one into our last webinar, but it was way too long, so we decided to delay it until this one. But the bottom line is that market structure is shifting, and not just within public markets, but within private markets as well. And what you can see here is that more than 80% of companies with revenue over $100 million in the US are privately held. And among these are some of the largest companies with over $1 billion in revenue. So fewer companies are going public and more capital is staying private. And like anything, there's pros and cons to this. But most people aren't aware of how large these private markets are today and how they may have an impact on the investment world as a whole. So the number of publicly listed companies is roughly half of what it was in the 1990s. And this is because companies are staying private for longer. And this really accelerated following the great financial crisis because of how access to capital from traditional channels dried up, aka banks, and private markets were there to fill the void. So in the year 2000, for example, there were roughly 2,000 private equity firms. Today, there are 12,000 private equity firms. And instead of a company going public to raise capital, they go public as a small company, they grow into a mid-sized company, and then they mature into a large company. These companies are remaining private, and they realize much higher valuations when they eventually go public. This has led to a loosening of restrictions and a deregulatory push to provide the public greater access to these markets, which require greater awareness and much greater due diligence because these private markets, they're less regulated with much less transparency, less liquidity, and in many cases, far more risk. And all of this has the ability to heighten market volatility, whether it be because traditional investors aren't whether it be that investors are engaging in higher risk areas of the market that they may not fully understand, or because of how large companies, when they come to market and are incorporated into widely held indexes, regardless of their track record and earnings. And while we can't argue some of the value that private markets provide, this does show some of the classic traits of the best intentions often come with unintended consequences. Tom?
Well, I'll reference 1998, where the financial markets imploded. Many may not remember it, but it did happen. And it was caused by a private hedge fund called Long-Term Capital. And it set the world into a spin. And we don't know what private entity might exist that's going to create disruption in the markets, but it's probably out there and it may well come from the private markets this time.
Yeah, there's a lot there. All right, Erica, we haven't referenced politics yet, and we're not going to go political here, but midterms, they often make for choppy markets and they're fast approaching. So will you please provide some perspective about markets during midterm years?
Yes. Somewhat hard to imagine because we haven't really seen it yet, but as Casey just said, midterm years have historically tended to be pretty choppy for markets and are usually prone to bouts of short-term volatility. Though in most cases, markets have actually moved higher in the 12 months following the election than during non-election years. So you can see in the chart, this blue line here represents S&P performance during a midterm year. The pink or purple line above it represents all the other years. But average performance for the blue line in the 12 months following midterm elections has been around 15%, while the pink line has averaged just under 8% in the following 12 months comparatively. So while it may not be pretty leading up to the vote, markets have historically bounced back even stronger than non-midterm years. But again, so far this year's elections have gotten very little headline attention as compared to previous midterm cycles, possibly due to some other things happening in the world at the moment. But generally, we've seen heightened volatility May through October leading up to the vote. And it's possible we may start to see some of that shortly. So please know that any volatility from here until November is normal and expected and may even provide some opportunities.
Right on.
All right, and our second to last theme here as we look ahead is about the federal budget, and in particular, Social Security and Medicare. And we probably receive a question per week about Social Security, and then that conversation morphs into a conversation about Medicare and Medicaid. And as we can see within the graphic here, Social Security, Medicare, and Medicaid make up a considerable share of overall spending at a time when the US is already borrowing roughly 25% of its annual budget. And these benefit programs or entitlement programs are expected to balloon in the coming years, especially Medicare and Medicaid. And I like to joke that as it relates to Social Security, that my 10-year-old daughter could probably put together a fix regarding Social Security, but she'd likely be voted out of the classroom because it would be unpopular. When it comes to Medicare and Medicaid, it's far more complicated. And hopefully this dilemma, hopefully it is a dilemma that AI can assist with when it comes to sort of reconfiguring our healthcare system and delivering some cost savings. And why are we bringing this up now? Well, because we're planning for change. And we've been planning for change within all of your plans by way of discounting Social Security and by way of inflating healthcare costs. But we've never seen federal debt levels and annual deficits this high outside of peacetime, nor during what we would consider a relatively healthy economic period. There's just not enough money to go around. So we cautioned people for several years about rising real estate taxes and insurance premiums during that low interest rate era from 2010 to 2020. And some were still surprised to see this materialize over the past 5 years. And we want to make sure that everyone is mentally and financially prepared for a range of outcomes as these subjects become more hotly debated during the midterms, and knowing that the next administration will have to address some of these fiscal realities. So being prepared is the message here. And our next slide is going to try to address maybe some of the emotional components of some of the turmoil to come. All right. And as we plan for what is expected to be a volatile future with enhanced risks and highly emotional and sometimes personal subjects, we conclude with the penalty kick lesson. Also felt appropriate given the World Cup. But the bottom line here is don't react. So the penalty kick lesson, for those of you who aren't familiar, goalies tend to dive right or left 95% of the time, while a kick straight down the middle scores 80% of the time. But only 6% of penalty kickers actually kick it down the middle. And when you study the rationale behind why the shooter tends to shoot right or left, or why the goalie tends to dive right or left, it all comes back to an action bias. It feels better to do something rather than nothing. Even though shooting it straight down the middle has a higher probability for success, it doesn't really feel like enough of an action. And when it comes to goalies, they tend to resist remaining in the middle because they feel like they have to move. Again, it's a behavioral bias. So when it comes to investing in portfolio management, it's really no different. Investors often act not because the action improves the outcome, but because of how inaction feels irresponsible. So the message here, don't react. we have a plan for distressed events in advance. That's why we're planning, so that you can let your plan do the work during these less comfortable times when they occur. Now, before we conclude, we thought we would share one book from each of us that's capturing our attention outside of the office as we reach midsummer. And I'll begin only because I'm currently speaking. I recently read 1929. Very entertaining read, but it was also in some ways a concerning read because the titans of tech today, from my perspective, resemble the titans of Wall Street in the 1920s. And it's fascinating with the benefit of hindsight to see how 1929 really did maybe feel like a sudden event that had been brewing for years. But without the media of today back then, people were able to enjoy the Roaring Twenties maybe in a way that they're not able to enjoy today. So certainly an entertaining read and an educational read with a lot of parallels to what we're living through today. Tom?
Yeah, I'm still wading my way through the bully pulpit, which, similar to Casey's book, is a historical context, but very valuable historical context because a lot of parallels to the early 1900s to today. The deregulation, huge corporations, concentrations of wealth, etc. And what we don't know is what regulations may eventually come in, particularly as it relates to AI. But the historical perspective I'm gaining from Theodore Roosevelt and William Taft are fascinating. And I think we're seeing it play out in real time. Now, Erico, tell us about your book.
Yeah, bring us home, Erica.
Well, unlike my scholarly colleagues here, as a middle-aged mom with a young child and a career and limited opportunity to read more than 10 pages at a time, I decided to engage in some light reading this summer and jumped on the ever popular Court of Thorns and Roses series and haven't regretted it. Currently on the second book in the series, and I will say if you're a fan of magic, fantasy, a little violence, maybe a little romance, the series is for you. It's got it all. So it's been a wonderful little escape for me this summer.
Thank you, Erica. All right, as we wrap up, it is important to remember that strong returns in volatile markets provide us with an opportunity rather than maybe this helpless speculation on what's to come, because we have an opportunity now to rebalance concentrations, address risk creep, assess the ability to live within our means when circumstances change, assess tax efficiency, revisit charitable strategies, review estate plans and goals, and talk about long-term care or aging with agency before it becomes urgent. These are all variables within our control, regardless of how markets and policy evolve. So again, in summary, when we look back, leadership continues to rotate, returns continue to broaden between asset classes and sectors. Important context, for now, it's all about earnings, the economic impact of AI, and the G-shaped economy while inflation finds its new norm. Also remembering that equity valuations remain historically expensive and have a long history of mean reversion. Stock and bond markets, key themes there for the future. Stock and bond markets are evolving from public indices to private markets, all require greater awareness to effectively manage risk. And with midterms looming and programs like Social Security and Medicare up for debate, expect volatility. And ultimately, as we just stated, now is the time to prepare for change. Bottom line here, as we just referenced, leadership is broadening, income is back, and the opportunity set is widening. And then again, use the current market environment as an opportunity to assess the financial variables of our lives that we have control over. So with that, please digest this update and any of our monthly updates along the way. If you would like to schedule some time with us to discuss any aspect of your plan, goals, or portfolio, please let us know. Share this with someone that may need some assistance with navigating complexity when it comes to their own financial affairs, if you feel it may benefit. And then lastly, reflect on, are you aligned with your values in your plan? Are there any changes that you'd like us to make? So with that, I'm going to share some disclosures to satisfy our compliance team. And then we did receive a few questions along the way that we were going to try to address here. But let me just flip through our disclosure pages here real quick. All right, great question here about, can we elaborate on multi-generational tax planning? And that is a loaded question because there's a lot there, and I'd say that it's very personal, and it's a matter of the family dynamics, current tax brackets, the adult children or their situations. But in general, if we begin to view, instead of everyone being part of different households, if we begin to view it as a singular household, and how do we help a family retain and preserve and reduce their overall tax exposure, there are decisions or ways, even if it's a subtle gift along the way, to be able to help families keep more of what they've created and what they've earned, reduce overall tax burdens. But there are a lot of non-financial components that go into that equation, in making sure that the gift is appropriate and making sure that it's for purpose and intent, as Erica referenced, making sure that we have conversations with one CPA about about tax exposure or gifts in general. And then there's also being able to stress test one's plan to make sure that the gifts are appropriate. Can the gifter, can the adult or the aging parent or the parent that wants to make the gift afford to make these gifts in a prudent and responsible way, knowing that circumstances will change over time? Eric and Tom, anything you want to add to
I
that?
just want to tease out something you brought up early on, Casey, probably a year and a half ago, 2 years ago, when the first Secure Act passed, and you talked about the forced distribution of IRA assets to your generation from mine, and what it could do for your kids who might be applying for financial aid if all of a sudden your income spiked because your father figure, this guy, died and left you a ton of money through an IRA that is fully taxable. What that does is spikes your income, spikes your tax bracket, and may take you out of the running for financial aid. We don't know how it's all going to play out, but it's those types of things where we get paid to look around corners for our clients that people don't think about, and we do.
Yeah, and even from the sense of putting together the distribution strategy with the next generation in mind. And that really comes to light when we start to look at everything through one lens and then the different variables within. All right. Any other questions here before we wrap up, knowing that anyone can call us at any time? We're all available to be able to assist. All right. I don't see anything coming through the chat box. All right. So on behalf of everyone at Clove Hitch, we want to thank you for being with us today. We are grateful for the trust that you place in our team, and we do not take that responsibility lightly. The future will always come with uncertainty, but it also comes with choices, and those choices compound over time. And our role is to help you make the next good decision, and then the next and the next, with clarity and confidence. And as always, we appreciate you and welcome any questions as they arise. Thank you.
Thank you.